And here we are for what will be the last macro money of this 2023 edition of this show. It's been almost a year since we've started to do this show on Tasty Live. This is Ilya Spivak, head of Global Macro, and we're going to take this opportunity as the year winds down to take a look forward and consider what is going to be with us in the first days of the coming year, because, of course, uncharacteristically perhaps for the first week of January, and an abridged one at that, it is absolutely loaded with relevant event risk. And of course, considering the tremendous tailwinds that have elevated markets in the last 2 months of this year, the key question that we ask ourselves is this something that has staying power? How did we get here? How are markets at record highs across a lot of the major benchmarks? And is this sustainable? And what we'll find is that as we look at the levers that had to be pulled to get us here and the risk we face to continuity next week, there's a meaningful set of questions to ask about sustainability and about what comes next. So let's start first with how we got here, then look at what's coming up next week, and then see what kind of a story that will tell, or at least what kind of a story it's likely to tell, and how that is likely to then reflect across financial markets. So the essence of where we start, of course, begins with the Fed. And what we see is that as it stands at the moment, with mere hours left of market action in 2023, the markets are looking at a blistering Fed rate cut cycle for 2024. On the left, that number of hikes and cuts column defines one whole rate move. In this case, cuts. You'll see that there are negative signs in front of all of them, as a 25 basis point or 0.25% reduction in rates. And what you see is by the March 20th meeting, one of these things is already fully baked in. A second one fully baked in for May. A third one fully in for June. Fourth one almost there with a 92% probability for July. Fifth one almost there for September, fully there for November. And then a sixth one, incredibly already priced in for December with a 25% chance for a seventh. Now, that of course means that the seventh one is carrying less than even odds. So let's keep it modest and say that there is 1.5% of a rates reduction already baked into the cake for next year's outlook. We are essentially looking at least one cut at all but one meeting, the January meeting. And if we consider the political calendar, we consider that the Fed doesn't really like to make policy adjustments very close to an election because it doesn't want to wade into the political debate. The implication is that if we are in fact going to get 6, then we might get a few clustered instances with 50 basis point rate cuts. If we start to get the Fed opting to sit on its hands into the second half, or perhaps into the fourth quarter at least of next year. So the benchmark for the cost of money underpinning markets here envisions rapid unwinding of the tightening that the Fed has been so doggedly pursuing in rhetoric since about the middle of 2021, in action since March of 2022. Now, what's interesting is that the bulk of this adjustment, the way we got here, happened not with December's FOMC, but with November's. So you can see here we have the implied path for rates as it's evolved from the November 1st FOMC, then to the December 13th FOMC, and up to now. That's the solid line there. So we can see the dovish shift from December to now is very modest. The dovish shift from November to December is vast. That's a big, big dovish adjustment in expectations. So the markets seem to have looked at what happened in November as really the pivot, and December as a kind of exclamation point, a kind of confirmation on that initial signal. You can see that in spades here. So as we look at the last several policy meetings, consider the last rate hike was July. There is no Fed meeting in August. Instead, in August holds the Jackson Hole Symposium, where everybody gets together and starts talking about big picture, lens setting type of considerations, and essentially lays out for markets the kind of thinking and the kind of framework that the Fed will apply for the subsequent year, or at least that it thinks it's going to. Obviously, the Fed has been surprised by events before, to say the least. But between the last rate hike in July and then the meeting in September, there's nothing but air. There's lots of conversation, but there isn't opportunity for direct action, at least not scheduled opportunity. What we find as we get into that September meeting is a very hawkish Fed that tells markets, yeah, so here's an updated set of economic and rates forecasts. And by the way, we think we're going to need about 50 basis points higher rates in 2024 by our reckoning as of September, as relative to the last time we did this assessment in June. And so the markets say, wait a minute. This seems to be a Fed that perhaps is done hiking. We believe that July was the last one. But it's not cutting anything in any kind of hurry. And what you see then is the front end of the yield curve, the 2-year yield showed in the green here. That's idling. That's the part that's the most sensitive to near-term changes in Fed policy. But then the long end of the curve, the 10-year in the red here, surges. And it surges lifted, as we can see here in the yellow bars, by a rise in term premium, which is essentially just the market saying, all right, we get the Fed's message from this FOMC in September. It's giving us what has come to be called higher for longer as a sort of catch-all headline for the signaling, which says, okay, We're done hiking most likely, but we're going to hold rates elevated for a while to make sure inflation is good and dead. And it's that longer part. Higher we get. But what's longer? How long is longer? And uncertainty about that seems to be that jump in the term premium. The market's essentially saying there is greater uncertainty about where rates will be further down curve. And so we are now going to need higher compensation for that uncertainty, which is basically building in the extra return on longer dated loans, i.e. the term premium, into longer end yields. And then comes the FOMC in November, where the Fed pointedly says, well, good for you, everybody. You've pushed up borrowing costs by precisely the 50 basis points that we said we would need in September. And now we don't have to do anything anymore. Thank you very much. You've just done the policy adjustment for us. This is a great example of the Fed conducting policy by guidance, by talking markets to where they want them to go without actually having to do anything. So here we have September. Long end rates go up as the term premium goes up. Here's November. We can see rates peak right here. The Fed comes out and says, right, we're good. And you'll notice this lands us right in between here, the 4 and 6 level, the 4 and 6 handle, which essentially gives us 50 basis points right there. So the market effectively does exactly what the Fed signaled in September was needed as far as further tightening. The Fed confirms here that the cycle is over in all but overt language. And what we get subsequently is a dramatic shift down in yields across the whole curve. And the uncertainty over the term premium unwinds. You can see it's now actually back to negative. As we get rate cuts baked in, the front end comes down. The baseline for where rates will end up longer term, that comes down. And the markets very pointedly are breathing a sigh of relief. We can clearly see what that amounts to as we look at the response from financial markets. So as November kicks off, here's the end of October, start of November right here, we can see this build in Fed rate cut odds for next year. You can see now the markets are hovering right around this 6 or 7 cuts area. So 6 cuts at a quarter point each would be 1.5%. 7 of them would be 1.75%. And you can see we're sitting right there. And of course, that's exactly what you might expect looking at, once again, this table. Here's 6, so that's 1.5%. With a 25% chance of a 7th, that's another 25 basis points or a cut of 1.75% on the year. That is exactly what this is showing us. And we can see that as we went from about 3 to 4 cuts, 75 to 100 basis points, that's this area here, to now 6 or 7, stocks have roared higher. In what is essentially the inverse of the move that was occurring from about mid-year, July into October, where the stock of rate cuts that are being expected for next year was shrinking because the markets were coming off concerns about the SVB and Signature led banking crisis. They were coming off concerns about not passing an extension of the debt ceiling by mid-year, as all of those things kind of got ring-fenced, and the market thought, okay, well, maybe there's not a fiscal crisis on the table. Maybe there's not a credit crisis on the table, at least at the moment. And if there's not, then do we really need such emphatic rate cuts? This, of course, is exactly the question that now stands before investors. This is where the peak in rate cut odds was against the backdrop of fears about two separate crises. There's no evidence of a crisis here now, and yet this is how many cuts are back on the table. And we say that there's not a semblance of a crisis, at least at face value, because, of course, look at what the S&P is doing. It is loudly cheering these rate cuts and saying, oh, good, the cost of money is going to come down, and it's going to come down quick. This will be a boon for economic activity. It'll be a boon for corporate earnings. It'll be a boon for risk-taking because it will allow people to take on riskier bets and worry less about what that would cost as far as losses if they went wrong because the money is cheaper. We can see that against the backdrop of all of this, the US dollar, of course, weakens as well because the yield support for it comes undone. Its yield advantage dissipates the more rate cuts get on the table. And this is where we are, big picture, as the calendar gets ready to flip over. Now, next week, we are going to get a vast amount of economic data to inform this narrative, but there are a few that stand out. And the first comes by way of December's ISM economic activity surveys. And what you'll find here is the beginnings of a theme that will repeat itself across economic data as it sort of is expected to occur next week. Slight slowdown on the service sector side that you can see in the orange line there, a slight modest downtick to 52.5. So slower service sector activity growth, but not by much. As ever, this is in the logic of a PMI index. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see here that on the manufacturing side, we've been contracting for over a year, but the pace of it has steadied. On the service side, we've seen a similar thing. We've been growing, but at a very modest pace, having climbed down from the peaks here in 2021. This is, of course, the COVID catch-up here, the economy getting essentially rebooted and turned back on after those COVID lockdowns. And so what you see here is a sort of steadying. Mild growth in services, mild or at least steadying contraction in manufacturing. And of course, services are what really carries the lion's share of the weight here. 80% of the US economy is services, 19% of it, give or take, is manufacturing, and about 1% of it is agriculture, as far as contributions to the economic growth story. So because services is mildly growing here, the U.S. economy is mildly growing because that's overpowering the contraction on the manufacturing side, and agriculture is just a very small contribution to the whole thing. So as you look at this then, you get the sense that next week's numbers don't really deviate much from the status quo. They give us a kind of middle of the road, slow, sluggish, but positive picture for the U.S. business cycle in December. The rest of the data for the week ends up looking like variations on a theme. Here is the job openings report, the JOLTS survey for November. The expectations here, slight razor thin uptick from 8.7 million vacancies to 8.9. We're, of course, decelerating still cautiously from the peak at 12, which occurs, shock of shocks, exactly at the same time that the Fed starts its rate hike cycle with a view to cool labor market demand first and foremost. But we don't really see anything in this incremental release, if it registers anywhere near expectations, that would upset the apple cart in a meaningful way. This is, like ISM, not a data release that screams deviation from the status quo. Then we get the lead in into employment growth data. First, the ADP report. This is a guesstimate of just the private sector payroll story. Slight uptick from 103 to 113,000 service sector or private sector additions to payrolls. Again, moving in the right direction, but very, very modestly. As you can see, very much in line with where we've been over the past several months, somewhere near the lower end of the recent range. Nothing shocking, nothing crazy. And then, of course, on Friday, there's the official U.S. jobs report. Here, too, relatively quiet. 170,000 jobs added to overall non-farm payrolls, very much within the realm of the recent range, averaging, let's say, between about 100 and give or take 300K. So very much in line with recent numbers. A slight increase in the jobless rate, but one that, again, keeps us very steady within this kind of 3.5 to 4 range. So all around this data, seemingly uncontroversial expectations. In the middle of all of it will be the release of minutes from the Fed's December meeting, where we might get a little bit more clarity about the Fed's embrace, finally, of the market's dovish inclinations. But as we see once again here, December wasn't the big meeting. December was a kind of reinforcement. It was November that marked the turn. And so what's really going to show up in these meetings? Minutes, then. Is it going to be something completely out there? Well, maybe, but that's unlikely. It seems like the meat of what the Fed had to say happened a month earlier, and the markets took notice accordingly. So unless there is something in these minutes that dramatically changes the assessment of what happened in December, and that's, of course, unlikely because the Fed massages this document. It's not an exact word-for-word transcription of what was said at the meeting. It is an editorialized account. So the Fed has the opportunity to shape that narrative and, of course, isn't in the business of spooking markets. And so where we get here, then, is probably a relatively staid document. As for the data, if we look at the way that U.S. economic data has performed relative to expectations, we can see it's cooled. This is data from Citigroup showing how U.S. data flow has behaved relative to forecasts. And we can see there that from about the middle of August, U.S. economic data has deflated somewhat relative to expectations. 0 would be it's exactly on forecast. Below 0 would be it's underperforming. Above 0 would be it's outperforming or tending to outperform baseline forecasts. In this case, we can see it's getting closer to 0. So the degree to which it's outperforming is fading. And it seems to be kind of stabilizing then. Forecasts and realized results seem to be coming closer into line. And we can see why. Because if we look at where market expectations for economic growth are, in particular for next year, the changes for 2025 that you see here are fairly modest. You can see we've gone from expecting something on the order of 2.6% growth to something on the order of 1.7. So we've shaved about 1%. Not really a big difference. But it's for 2024 where there's been a much more significant adjustment. So here, it would seem, we've come from looking at something like 0.6% growth to a much more significant increase, and the increase has been much more clearly shown in the forecast. Now, what's interesting about this is, of course, this adjustment begins right around the middle of August, as does the pullback here. And so what this is saying is essentially the data is performing less well relative to forecasts because the forecasts themselves have been adjusted higher. And things are coming closer into line. All of which seems to suggest that these expectations for middling outcomes are probably going to get met, give or take. We're probably looking at data across ADP and NFP and JOLTS and ISM that doesn't really break new ground. And then, of course, the natural question is, well, if slow and steady continues uninterrupted, why in the world do we need 6 rate cuts? On par with the kind of policy outlook that we were facing in the midst of worrying about these dual crises at the start of 2023. And if we don't need 6 rate cuts, then is there a case to be made for stocks to come back in, for the dollar to rebound, because the markets have gotten ahead of themselves? It would seem you don't need much to get there. You don't need for the data to look better. You just need for it, as you might expect looking at this, this performance here, to be about baseline. And if baseline is where we are, well then, does it really make sense to need so much easing and to have the Fed dive headlong into this massive stimulus effort as soon as March? That, of course, presents a potent risk to everything that we've seen in markets over the past 2 months. And as it happens, if we look at the history of Fed rate hike cycles relative to market volatility, we can see that there tends to be a spike in the VIX volatility index about 2 years after the start of a Fed rate hike cycle. Now, in fairness, this is not something that has a tremendous amount of data points on it. There's only been so many rate hike cycles since there's been a VIX in existence. And there's not been that many rate hike cycles since the modern version of the global monetary order has existed, which dates back to somewhere in the mid 70s with the end of the gold standard. And then, of course, the late 70s, early 80s with the massive disinflation led by then Fed Chair Paul Volcker. We're looking at the peak of that effort right here, where you can see that rates are topping out close to 10% in the double digits, nearly double of what they are now. And so since then, not that many tightening cycles. I mean, 1, 2, 3, 4. This is the 5th. So it's not the biggest sample space ever, but it does seem to suggest that if the pattern holds, we are entering a period here where we're just about 2 years into the current cycle, and so just about on time for another one of these spikes. So if the market wakes up next week and says, here we are, it's January, what's the next year look like? How many rate cuts do we have baked in? Does that make sense relative to this economic data? And if it doesn't, do these stock gains make sense? And do these dollar losses make sense? Well, a mere readjustment just on the basis of closing the disconnect between growth dynamics, valuation, and the Fed outlook, the makings for a volatility spike, certainly not a crisis level one per se, but some sort of elevated pickup in volatility seems to be taking shape. Which of course means that as everybody wakes up from the New Year holiday and starts next week, we may be off to the races on some dramatic market action pretty much right out the gate. And that is Macro Money for today. As I mentioned at the top of the show, it's also our last show for 2023. It's been just about a year since we started doing this. It's been a great time. Thank you very much for all of your incredibly positive feedback, for your viewership. Macro Money will be back first thing in January. Have a safe and happy holiday. Have a happy new year. See you soon. Take care.